Good afternoon, everyone, and thank you for joining us today. My name is Calum, and I work on the research team here at StuRents. Before I hand it over to Richard, there are just a few bits of housekeeping to take care of. Firstly, this webinar is being held to coincide with the release of our quarterly reports, which are due to be released in the next few days. Secondly, the session is being recorded, and we'll make sure everyone on the call receives a copy in due course. As always, we are excited to be joined by several leading industry experts. We'll be continuing discussion at the end of the data presentation and hopefully answering some of your questions. If you do have any questions for us, please submit them via the Q&A function in Zoom, and we'll try and get through as many as we can. On that note, I would like to introduce the panel. So if I can start with Sam, are you able to give us a quick 30-second introduction to yourself?
Of course, thanks, Calum. So I'm Sam Rason, founder of Viva City. I've been working in the Chinese market for the last 10 years with a focus on student housing and property over the last 4 years. Essentially, we build mini programs for property companies to help increase their direct sales with the Chinese market.
Great, thanks, Sam. And if I could pass over to Ant for a quick intro.
Thanks, Calum. Good afternoon, everyone. My name's Anthony. I'm a partner and head of the student housing team at property consultancy Allsop LLP. Our team is split between the north with an office in Leeds and the south out of our head office in the west end of London. We're dealing with a vast array of student housing from portfolios of HMOs, converted buildings, and small and large scale PBSA.
Great, thanks both. We look forward to hearing from you shortly and tackling some interesting questions. Before I hand over to Rich to run through today's data, we do have a number of poll questions that will be appearing on your screen shortly. So number one, so how have your expectations changed for 24-25 PBSA rental growth over the last 3 months? So that's just between more positive, neutral, more negative. Number two, on the HMO side of things, what are your current expectations for rental growth in the HMO market for 24-25? So again, just a range of growth figures there. And then number three, how's your overall view shifted towards the student accommodation market over the last 3 months? So worth noting that poll can be minimised once you've locked in your selections. So with that, I'm now pleased to hand over to Richard to run through today's data.
Thanks, Calum. As Calum just mentioned, do feel free to minimise that poll, but we'll look through the answers to that towards the end. As always, we've got quite a lot to get through in a relatively short space of time. So we're going to start off with some of the latest demand data from Office for Students. We'll then have a quick look at year-on-year changes to specifically PBSA occupancy. And then we're going to dive into some of our usual insights, so looking at changes to search behaviour, as well as the latest planning updates. And then, as Calum's already said, we'll hear from Sam and Ant before doing some Q&As towards the end. So to start off with, we wanted to kind of run through the latest data from the Office for Students. So I think this is interesting because from the conversations that we've been having with various customers, it feels like this data has somewhat flown under the radar. Now, for anyone that's not up to speed, there are still issues around the latest data release from HESA. So their 2022 data set is still yet to be published. The latest is that should be published in August. But that does mean there's big issues around understanding the latest demand trends. So we started to look at the data from, again, Office for Students. Now, the reason this is interesting is it goes up to 2023. So it gives us a slightly more up-to-date view with regards to what's happening to demand. The only slight caveat to that is it only covers England. So it obviously doesn't cover Scotland or Wales. So what the data shows us initially, which again is interesting, is how that demand has changed, split by postgrads and undergrads, which we can see on the right-hand side. So if we look at 2023 as a good example, undergrad growth was pretty minimal, but actually postgrad numbers declined year on year by 2.3% after pretty rapid growth, particularly post-COVID. Looking at the undergrad numbers, again, interesting to know the differences here. So Office for Students use slightly different terms to HESA. So they classify either home fee students or those from overseas. So if we start with the home fee student numbers, we can see actually they've been declining the last couple of years. Now, these numbers from the Office for Students are early estimate numbers. So there is some possibility they won't be the final figures. But from what we've looked at, they are very highly correlated to HESA. So again, they're giving us a very up-to-date view of those latest trends. In terms of the overseas numbers, they continue to rise, which is obviously positive. Last year, or in 2022, double-digit growth, but has slowed slightly in 2023 to 6.4%, but again, still positive growth, which is great to see. There's been quite a bit of press coverage around university finances, which we'll maybe come back to a little bit later. But obviously in the current environment with inflation and with the fact that tuition fees haven't risen for around a decade, obviously there are big incentives for universities to continue to recruit overseas students, given the higher fees they do get from those students. So it's not unsurprising to see those trends play out. Obviously, we'll keep a close eye on that, but all being well, we would expect obviously continued growth from overseas. Also, worth just a quick note, yeah, there are a lot of pressures around finances for students. So again, possibly cost of living starting to bite for undergrad domestic students could be playing into that as well in terms of that year-on-year decline. Looking at postgrads, and again, splitting that by home fee students and those from overseas, what is really interesting there is to see the huge divergence in that trend. So quite clearly, home fee students have actually been in decline for at least 3 years now. In 2023, down 5.2%. But what is clear from that data is you can see the huge growth that we saw kind of post-COVID, so 2021 and 2022. 2023, that's essentially stalled, so a slight reduction year on year. Obviously, if we look at the data by individual countries, I think, again, it's been well reported, there was huge growth in Indian postgraduate numbers. Nigeria was another one as well. We saw strong growth there, and that's going to be driving that recent trend. We've looked at things like visa changes, obviously changes to dependents in particular have impacted that demand, particularly from India, along with currency changes and general sentiment from the government around immigration. So that, again, is going to be playing a part as to why we've seen that postgrad number or growth essentially stall somewhat in 2023. As always, though, there is huge differences between universities. So this particular slide, starting off on a positive note, and we've just picked a handful here. So we can see Bristol, Birmingham, Manchester, Leeds, and Leicester. So whilst nationally that growth for 2023 had flatlined, some universities have continued to report strong growth. And if we look at those numbers from Manchester in particular, a 41% increase in terms of those numbers in 2023 versus 2021, yet home fee numbers were down 14%. So again, a huge increase in overseas postgraduates, particularly at Manchester, but again, some continued strong growth from select universities and select locations. At the other end of the scale, we have seen a lot of volatility, again, particularly around postgrad recruitment. Again, we've picked a handful of locations here. You can see Coventry, Portsmouth, and others, where they did see that growth post-COVID, but that has essentially reversed pretty rapidly. So if we look at Portsmouth as a location, for example, we saw postgrad numbers decline almost 44% in a single year, which is obviously very large. Coventry, again, you can see from the line chart on the right, equally very big year-on-year drop. Question is whether that trend has continued into 2024, but again, not particularly positive. And that does make it very difficult to then predict future demand, given that level of volatility, again, specifically around postgrads in this case. Somewhat changing gears slightly, what we wanted to do, and it's something we've kind of discussed in previous sessions, but it's worth reiterating, is obviously that volatility around demand and how the market looks at supply and demand will be impacted by that. But what I guess piqued our interest, particularly with recent conferences, is still a somewhat misunderstanding sometimes of how the market looks at supply and demand. So we went to the LD conference a couple of weeks ago, and there were various presentations where essentially the markets, or those at the conference, were showing the number of students in a location relative to the number of PBSA beds, and therefore implying markets were undersupplied. So if we take the example of Coventry, I think most in the sector are aware Coventry is a challenging market. The slide on the right is essentially what we were being told at the LD conference. So we were being presented that demand is higher than PBSA supply, and therefore implying that market is undersupplied. In reality, which we'll see in a minute, the situation is very different. So again, it's just worth reiterating that when we're looking at things like ratios or headroom analysis, just to take that with a pinch of salt, because again, the reality can be very different. Obviously, this type of analysis doesn't take into account the HMO market. It assumes that every student wants to live in PBSA and can afford to do so, and that's obviously not exactly true. So again, just worth bearing that in mind. If we look at an alternative analysis, which is what we typically do for our customers looking at supply and demand, again, you get a very different outlook. So Birmingham remains positive. If we look at Coventry, though, the bar on the right represents change in supply. The dot represents change in demand. And essentially, you can see in somewhere like Coventry that supply growth has massively outstripped demand growth, and therefore that market has become a challenge. And that is the complete opposite view of what we saw from the previous slide, which again is traditionally how the market sometimes looks at supply and demand. Nottingham is what I'd classify as interesting in the sense that supply growth is tracking there or thereabouts in relation to demand. So again, one to keep an eye on. I know a lot of people are interested in Nottingham, but it certainly seems that supply growth has been, again, tracking pretty well aligned with demand, possibly slightly above now once you take into account the number of beds delivered this year. But again, going back to Birmingham, the complete opposite, where demand growth has continued to outstrip supply growth. That leads us into occupancy, and one of the initiatives that we've started a while ago and is now really ramping up is we have many participants in the market providing us with their occupancy data, and that data is being aggregated and provided back to those participants so they can track occupancy over time versus the market. If you want to find any more about that, do just contact us afterwards and reach out. But that does mean we can start to look at year-on-year trends. So what we wanted to do in this particular case is take a selection of cities within that survey, in this example 10, and just split that by studios and clusters. So the chart on the left-hand side, again, is looking at how the occupancy or booking velocity, is probably the better way to describe that, was recorded in March this year versus last year across those 10 cities. And we can see 9 out of the 10 have shown a year-on-year decline in performance. For clusters, it's a lot more mixed. So we've got 4 in this case, represented by the blue dots, that were tracking above last year. But you can see, again, a big variation between individual locations. And that's going to be impacted by changes to demand, which we've mentioned, possibly changes to supply in those locations that have seen more beds being delivered. Moving on to search behaviour next, and just see how that has changed. So again, this is a slide that we typically incorporate in these webinars just to show how that is changing. And this is looking at, of those searches being performed on the platform, how are they distributed in terms of size or unit mix, if you want to call it that. So if we look at Q1 2024, and that actually relates to October to December last year, which we classify as the first quarter of the 2024 cycle, we can see most of the demand was around 4, 5 and 6 beds typically, and that's going to be driven mostly by the domestic market, looking for those HMOs or cluster flats to live with 3, 4 mates essentially. As we move into the next quarter, which would be January to March just gone, we can see how that demand has shifted, and we're seeing more interest for 2, 3, 4 beds, as well as studios and 1 beds as well. Obviously, that's really important from a marketing standpoint, making sure you're aligning those strategies to specific demographics and the particular product types that they're looking for. Having said that, the distribution is very much what we'd expect. So this year versus last year, which we can see on the right-hand side, is pretty much banging line. So no major changes there. And that really reflects the fact that seasonality pattern is pretty well established. So yeah, no real changes year on year. What is interesting, and we'll come back to this in a minute when we look at the pipeline, is how the market is not necessarily trying to go after the cluster sizes that are most in demand, with a lot of clusters being put forward in planning, typically at the higher end, so 6, 7, 8, 9 beds, for example, when our data doesn't really show much demand at that level, and it's more, again, 3, 4, 5, possibly 6 beds as well. Another trend we just wanted to give an update on is around the price points that specific demographics are looking at. So on the left-hand side, we have searches from UK students. On the right-hand side, we have those from China. And looking at the Q2 data, we can see that those from the UK were looking at properties that were 3.4% higher than last year. If we look at the data from China on the right, up about 3%. So there is still some year-on-year growth there, which is great. Obviously, still relatively early in the market cycle for international searches, but it'd be interesting to see how that plays out. What we can also clearly see from those two demographics, which is something we've discussed at length before, is the difference in price. So you can quite clearly see that your average Chinese student looking at properties well above £200 a week, whereas those in the UK significantly less than that. Moving on to planning next. So in terms of broad activity at a national level, the chart on the right is a running total over the last 12 months, either for the number of beds that have been submitted or the number of beds that have been approved. And certainly what we've seen in recent months is a slight increase in the number of beds being put forward, which is good news for students in particular, but that's yet to flow through into beds that are being approved. Just to give some numbers there, so we've seen 11,800 beds submitted so far. That's up from about 6,800 last year. In terms of approvals, almost 8,000. Again, that's up from the same period last year. So we have seen a slight increase there. Again, we're going to keep a close eye on that to see whether those do come through into approved beds and eventually delivered beds as well. In terms of activity, though, that really in the last quarter has been focused on very few locations. So you can see on the pie chart on the right-hand side, London and Glasgow were the hotspots. So in London, 39% of all beds submitted in the last quarter were in London, whereas in Glasgow, that was 26%. And Glasgow, again, is an interesting one. It's been well reported, the fact that market is undersupplied, but we've certainly seen a rush of applications looking to fill that void. And actually, if we look at those beds being submitted January to March, there's more than 3,000 in that one individual quarter. If we look at that and compare it to the level of existing PBSA stock, that represents growth of about 15% if that was all delivered. If you take into account all of the beds in the pipeline in Glasgow, the potential for PBSA growth is more like 47%. So potentially significant growth in the future. Obviously, not all of that will potentially come in, but still noteworthy. In terms of the types of beds being put forward, again, very similar to what we saw before, but in the last quarter, a big skew towards studios, making up over half of all beds being put forward. Some interest in 5 beds, but as I touched on previously, a lot of the clusters are looking at 8, 7, 6, 9 beds, which again is not typically what students are searching for when they're looking for clusters, which are typically a little bit smaller than that. Obviously, there's a lot more than this. This is just a summary and some highlights, but just to go through these very quickly. Some of the notable submissions, so we've seen a 900-bed scheme in London. We've seen very big schemes being put forward in Glasgow, which we've already touched on. Also, a pretty large development in Nottingham as well, on Players Court. The biggest approval we saw in the last quarter was from the University of Manchester. So that university has a huge 3,300-bed project in the pipeline. The actual net increase will be less than that because they're demolishing a whole bunch of beds and taking that out of the market. But again, interesting to note, they've got pretty big plans there from an accommodation standpoint. And you can see, again, a few of the highlights in terms of the number of beds being approved. Just one last thing that's worth mentioning. I presume most on the call have come across this, but Obviously, the financial health of universities has been in the press a lot recently. I think at last count, there's around 60 institutions that are planning some kind of cutback, whether that's teaching or staffing. So it's one that, again, I think we'll keep a very close eye on, but it's just worth raising for anyone that's not familiar with that. Obviously, that potentially has an impact on demand as well. So to summarise quickly, as we kind of saw at the start, there has been a lot of volatility around recruitment and demand, and that's making it particularly difficult to forecast how that's going to be changing going forward. Obviously, that plays into supply and demand, but again, do take some of the analysis in the market with a pinch of salt. It's not always giving us the full picture. Planning has increased, but very much targeted to a handful of locations. And the last one, just to mention as well, which we've not covered, again, I assume most on the call have come across it, but the MAC report that was released a couple of weeks ago was positive for the industry, not seeing any changes to the visa graduate route, which I think everyone was relieved about. Renters reform bill also looks like it's been kicked into long grass given the pending election. So again, that's broadly going to be welcomed by landlords. And as I've just touched on, I think keeping a close eye on higher education's institutional health in terms of finances is going to be a key topic over the next kind of 12 months or so. At this stage, I would like to hand it over to Sam. If you give me 2 seconds, Sam, I'll just give you control and then you can run through your slides.
Fantastic, Richard. Well, thank you very much. Super insightful. I thought first it would be better just to give a slightly fuller introduction to Viva City and exactly what it is we do. So we build WeChat mini programs for student housing and property companies. The best way to view a mini program is it is just like a website or app, but it's hosted inside WeChat, which is China's #1 social platform, has about 1.3 billion active users. So this means these apps can be accessed very easily inside China and outside of China. They can be shared freely across social media. So why may you use a mini program? Most of the circumstances is to improve the buying journey for Chinese tenants and to generate more direct sales opportunity. Just to visualize what a mini program looks like, I just thought I'd take you through a few different stages. So the first stage is obviously discovery. Many students are finding these mini programs by searching for them inside WeChat, but they're also discovering mini programs from operators' websites, whether that's via a QR code or via a button click, and they're sharing these mini programs in WeChat to their friends, on their timelines and to groups of students that they may already be living with or planning to live with in the future. It's a very streamlined booking journey process. So we always have a homepage of some sort, enabling a student to pick a particular building where they can go on to view room information and contract information. And then finally, the endpoint would be to submit some kind of inquiry form or a booking form. And one point to note is we're able to integrate these mini apps with tools like StuRents Channel Manager, so we can optimize and make the mini programs more fluid operationally. So it's good to understand how users are actually finding these mini programs. We'll circle back to the main one, which are essentially repeat users. But the main portion of students and Chinese tenants are searching for these mini programs on WeChat. They're also finding these mini programs from a brand's own website and engaging that either by scanning a QR code or button click. But we can also see quite a strong portion of Chinese users sharing the mini programs inside WeChat. And then finally, the other point to note is these mini programs can be embedded into WeChat articles. So it's a great way to convert people from a marketing lead into perhaps more of a sales prospect. Taking a look at the user demographics for the UK market, as we'd expect, nearly 2/3 of users are based in China, but interestingly, just over a quarter are based in the UK. And this tells us that Chinese consumers prefer to and like to engage with platforms that they're more familiar with and also in their own language. And then when we look at the age of the users, again, no surprise, the 18 to 24-year-old bracket is the biggest one. But an interesting observation is that there are older users of the mini programs, And from research, we tend to find that parents are being shared the mini programs and the building and room pages from their children. So we can assume that parents are playing a significant part in the decision-making process for Chinese tenants looking to study and live overseas. I thought first, before we drill into the current data, it'd be good to look at the 23-24 academic year. So what this graph is doing is looking at the total amount of inquiries we had from the 1st of October 2022 to the 30th of September 2023, and work out what portion of those inquiries happened each month. So even though last year was a very vibrant year, extraordinary in terms of demand from Chinese students, as Richard alluded to, the international market does tend to ramp up as we get into the summer. So last year, August 2023 was the strongest month, but most of the summer activities started to occur from July. So we would expect to follow trend again this year. Taking a closer look at this year, and is looking at the data from October just until yesterday, until May. Kind of similar behaviours, but we did see something different in November. We saw a lot of Chinese social media activity, suggesting that some markets, particular places like Glasgow, it was important to book early. So we saw November have a more significant portion of inquiries this time round versus the year before. But apart from that, it's really following a similar kind of trend. This particular graph and data set is trying to look at what happened last year to what's happening this year. So we certainly saw that strong start to the 24-25 cycle, but from around February onwards, there has been a slight decline compared to what happened the previous year. We are expecting a bullish summer like last time round. And interestingly, there's a lot more page view data that we're going to get on just to show how perhaps some of the behaviours of Chinese students are starting to change as they get more opportunities to research the buildings and the brands that they want to live with. It's important, however, to look at specific cities. So I've just picked out two interesting ones that match similar to what Richard found. So London is up in demand this year, and there are places like Leeds where we're seeing exceptional growth. Birmingham and Manchester were other markets, which again, Richard pulled out on one of the graphs. So for anyone looking to drill down into the Chinese market, it's really important to look at each city specifically, as there are pretty large variations year on year. One interesting observation we've discovered too is a growing interest in the build to rent sector. Birmingham and Leeds in particular are seeing strong interest. So from around February, whilst much of the PBSA market, we saw a decline against last year, we've actually seen an increase in demand for build to rent and serviced apartments. Something to also look into is the types of users that are finding and engaging with our build to rent mini programs. More of those users are actually based in the UK. So what we can take from that is that as Chinese tenants move to the UK and get more familiar with the UK landscape, they tend to research more and discover more opportunities and places to live. And it's important, therefore, to consider from a marketing lens, the current students living in the UK, as well as those that aren't already arrived in the UK yet. We looked into this data just over the last 90 days, just to gauge the price range. Again, it matches from the StuRents data at that £200 to £250 price point is where most of the inquiries and bookings we're seeing, but there is a broad spectrum. There are a broad number of Chinese students that are coming to the UK from different economic backgrounds. So this is what we'd expect to see moving forward, with a breadth of different price points being looked at by different Chinese students. I touched on this at the beginning. One certain observation is that there definitely is more Chinese students and Chinese tenants looking at different pages across all of our mini programs this year. So total page views have increased, even though inquiries have started to fall back a little bit since February. There has been a significant increase in repeat users too. So our takeaway from that is that students are spending much more time researching across brands before booking this time. And we'd expect to see that increase of actual bookings come a little bit later in the summer. So first, I just wanted to summarize those different data sets. Chinese tenants are spending more time researching across different platforms, in particular WeChat and Little Red Book. Parents are definitely a key stakeholder in the decision-making journey, and that may need to be considered on any types of marketing activities that you're doing. Whilst like-for-like inquiries have been slightly down since February, in terms of direct inquiries across all of our data sets, we have seen more interest from Chinese students to come direct this year. There is definitely growing interest in the build-to-rent market, particularly from Chinese students already living in the UK, and it's super important to look at city-specific data as it varies significantly year on year. But one final slide before I hand back. This is really looking at some recommendations we can share to help you increase your direct sales from Chinese tenants. The first recommendation is to pay attention to your brand on Chinese social media. Many students are more familiar with buildings, but brand is super important. And for anyone that wants to build a direct marketing strategy, certainly brand should be should be one of the key pillars of that. It's super important to provide high quality information about your properties in Chinese. Chinese agents are very good at bringing lots of different information together. We often see requests asking for floor plans, videos, 360 tours. So that kind of content is particularly helpful for your Chinese audience. Some other research we've conducted recently is lots of Chinese tenants aren't overly familiar with the booking process and in particular the cancellation process when they look to live overseas. So it's very important to educate your Chinese customer on how to book, what do key terms mean, what does a guarantor mean, and if they do need to cancel, what do those terms look like? And this really helps them de-risk their decision and enables them to come direct to book with you. Point number 4, this is really about trying to grow your demand. One easy win is to ask your Chinese tenants to post about you on Chinese social media. Little Red Book in particular is a great one. And just to really look at the general lens of can you build a direct-to-consumer strategy, it's definitely a viable option, but you really need to consider the marketing aspects, the platforms such as the mini program, something easy for Chinese tenants to go through and make their decision. And then in terms of the sales process, lots of Chinese students do need help with that booking. They do need help going through that booking journey, which they may not be able to access fully inside China. Payments is another important factor. So do consider those 3 key areas, and then you'll be on your way to growing your direct sales with the Chinese market. And with that, I will hand that back to Richard.
Perfect. Thanks, Sam. Really useful. Ant, I will give control to you. So if you give me 2 seconds. Just bear with me. Okay, Ant, any second now, you should be able to control the slides and look forward to your presentation. Might just take a second. There we go.
Thanks, Rich. Good afternoon, everyone. What I'll do in the next 10, 12 minutes or so is just set out a view of the market from an agent's perspective, touching on some of the common themes and frustrations, what we're seeing and dealing with day to day, really. What it essentially has morphed into is a bit of a summary as to why deals are taking seemingly longer than ever before. Given the time limitations, I will focus primarily on operating income-producing assets rather than the development and funding landscape. What I want to start by saying and make very clear is that the availability of capital, and this goes for every subsector of the student housing market, is most certainly not a problem. However, what you'll have probably seen, read, heard, is that transaction volumes for the 12-month period are down, but this is not a reflection of investors' complete conviction for UK student accommodation, which remains as strong as ever. So I wanted to dig under the surface a little bit. Why are volumes down, yet appetite is so strong? Feels like it's almost as like we're battling agents, investors, solicitors alike against wider forces to try and get deals over the line. And whilst I don't want this presentation at all to be overly negative, there are factors limiting transaction volumes, frustrating the flow of capital, and subsequently disguising true investor appetite. I have listed 6 reasons, 6 factors, which I will fly through now, but I'm happy to pick up with anyone listening offline should they wish to discuss anything further in greater detail. First, and probably the most obvious, but cannot be overlooked, is the cost of debt. And you don't need me to tell you the challenges posed by the current debt environment. These are very obvious. But what we've seen as a result is a growing demand for value-add opportunities or development-led opportunities where the cost of debt can be better absorbed than it can for stabilised income-driven investments. We've also seen strong levels of activity at the top end of the investment scale, where institutional buyers are benefiting from a lower cost of capital. However, like all other real estate sectors, we need a positive sentiment change to infiltrate and impact swap rates, to change the outlook and the forward-looking debt landscape. And of course, that first rate cut is key, if not making a huge impact on investor returns, at least making an immediate sentiment change. We expect this might nudge the floodgates open somewhat. With all of that, hopefully on the horizon, agreeing acquisitions now, leading into the summer, could give buyers some favourable upside, as we do expect activity to gather pace alongside rate cuts. The second point I would raise is asset performance, which might seem like an odd thing to say. However, to varying degrees, financing costs have been offset by rental performance, which is clearly a positive for vendors. But such strong performance in some areas of the country has encouraged vendors to extend hold periods. Holding stabilised assets beyond initial business plans has limited the volume of stock coming forward to market. We expect buildings that are in the holding pen will provide further opportunity for investors when macroeconomic factors are perceived to be improving. The third point is pricing and sales methods. There's still a bit of uncertainty around pricing. And as a result, we, like many other agents I know, are being asked by clients to engage with an initial shortlist of potential buyers. It's a favoured method and a flavour of the month, as buyers don't want to be perceived as overpaying and vendors don't want to be perceived as underselling, which is totally understandable in the current changeable environment. But if we're thinking about transaction volumes, then this sales methodology is far, far slower than a traditional marketing campaign. Firstly, it's very difficult to nail down the buyer without a full market engagement. And when and if you do, you then don't have any tension to drive the deal forwards, putting too much control with the buyer. It's almost as though sellers are dipping their toe in the water, testing market sentiment and trying to get a feel on pricing before committing to a formal approach. This has all led to a fairly closed deal environment where little information is being shared on transactions that have occurred or are occurring. This isn't really helping matters and is naturally extending what feels like a price rediscovery phase. The fourth point on the slide is EPCs, which are definitely worthy of a mention. They have become another layer of due diligence, and gone are the days where we used to be able to put an EPC in a deal room and hear nothing about it. Buyers are wanting to understand the current rating in great detail and ascertain options and associated costs of making improvements to meet investor targets and retain asset liquidity. This adds time, but importantly, also is a new level of pricing risk to the seller. The fifth point, and I'll try not to labour on this one too much, the fifth point is compliance and building fabric. This is the single biggest contributor to the extension of transaction timeframes, and even culminating in the collapse of some deals and the scaling back of others. In the main, it relates to fire safety related building fabric matters, and it is without doubt impacting volumes. Clearly, everyone wants the same outcome here, which is for buildings to be safe. The problem is that we don't really know what safe looks like anymore, as we seem to have a complete lack of clarity and inconsistency with the reporting that's coming through the sector. Not only that, there is this distinct difference between what can be deemed safe now and what level of remediation is potentially required to future-proof an asset to ensure buyers don't face liquidity issues on future exit. Fire risk assessments, or FRAs, are front and centre to this. These are a legal requirement as per the 2005 Fire Safety Order. For some high-level context, and I try not to get too into the detail of this, FRAs provide an assessment of risk to life range from low to medium to high. These consider several factors, but those that are tending to surface and create major deal hurdles or lengthy time delays at least are fire doors, fire stopping, and compartmentation. Basically, these are all matters that relate to the control of fire spread within a building. The issue is that FRAs are heavily caveated and openly subjective. For example, one assessor might recommend replacing fire doors, whereas another assessor might make a recommendation to fix existing fire doors. The trouble is that the cost of implementing those two recommendations is vastly different. And who's right? Well, of course, buyers will adopt the more favourable approach to them, which is usually to replace everything. In addition, FRAs will reference the need for further information if assessors deem there to be contributing safety factors relating to the external facade. That will often require something called an FRAW, or you might hear PAS 980. FRAW is an acronym for Fire Risk Appraisal of the External Walls, which is essentially a methodology of assessment. And PAS 980 is just a guidance used to determine the risk profile of a building. As I say, I don't want to go into too much detail on all of this, but I will make a couple of points that you might find helpful. The first is to dispel a myth. Building height is irrelevant. FRAWs address the life safety risk from fire spread across external walls for multi-storey blocks of any height, not just those over 18 metres. Your building may not look as though it has combustible elements, but not all materials are visible. Often the wrong insulation or the lack of cavity barriers are problematic, and neither of these are visible to the naked eye. So if you're selling, it is worth engaging with a fire engineer to ascertain a rating for your external walls, also known as an EWS1. If required, an FRA can inform the EWS1 rating, but an EWS1 rating is now what all buyers expect to see, regardless of the nature of the building. It's become standard practice. We have clients that won't even engage with an opportunity without a rating being established prior to marketing. My biggest frustration, and I think my team's biggest frustration, is similar with the FRAs, is that you can engage with different fire engineers and end up with two completely different EWS1 ratings. So we've had instances on live sales whereby one expert informs the deal that a building is a low risk A2 requiring no remediation, and another concluding that the same building should be given a B2 rating, thus requiring immediate remediation. How did we come to this? Well, what the government did was they recognised that EWS1 was a very blunt instrument and that B-rated buildings were creating liquidity issues when in fact they were safe, low risk, tolerable risks. So the PAS methodology provides the experts, the fire engineers, with the scope to determine risk via a detailed framework. The issue with that is that it leaves the door open for opinion and interpretation based on experience. And as no one building is the same, we then end up with is differing conclusions from different assessors. Well, that's hugely problematic in the context of trying to agree a commercial position to facilitate a deal. And as an agent, you can't possibly intervene here because we don't have the necessary qualifications. So I'd love to know the volume of deals stuck in this technical due diligence phase, with buyers and sellers trying to quantify the outcome of these reports and agree a way forward. You need pragmatism, certainly, on both sides to stand any chance of progressing through this part of the due diligence stage on any deal presently. And finally, and for good measure, the government threw a curveball at us with the removal of multiple dwelling relief. So what does that mean in practice? Well, we've either been busy trying to get stuff over the line before tomorrow's cut-off, or trying to find ways of absorbing the additional cost for existing deals by exploring corporate avenues. Whilst we might see a spike in transaction volumes, where deals are expedited to meet tomorrow's deadline, going forward, any switch to make corporate transactions the norm would have quite significant time implications. And there's the question of price adjustment to address for those deals that cannot be simply flipped into corporate transactions, which may add further stress to deals that are already in play. I just wanted to touch very briefly on HMOs, as this is a sector that we retain very good coverage on. We've got a few HMO portfolios in the market at the moment, and really the backdrop is very similar to what it is in the PBSA space. Demand tends to focus towards Russell Group university cities, certainly for established national buyers. So where we've seen opportunities that sit outside of those areas, we need to push the yields out, the gross yields out to say 10% and more to generate sufficient interest from new entrants and more localized investors. The marketplace has been quite quiet over the last 12 to 18 months, but this is a result of several factors. I think large-scale HMO buyers held back as interest rates started to rise, assuming that there might be some pain amongst local landlords that they may be able to take advantage of. But the reality is we haven't seen that pain as they might have expected. We aren't seeing any distress in HMO because the sector continues to perform so strongly. Barely any voids and relatively sensible rental growth. And a bit like with PBSA, where asset performance is so strong, vendors don't really need to sell. And HMO landlords can wait it out for a perceived stronger market. So that dynamic has dampened volumes somewhat. There has also been some uncertainty in the background around rent reform, which did look as though it might take effect imminently, but as Rich mentioned earlier, didn't quite make it through the parliamentary wash-up process. So that policy is somewhat in the abyss now. But overall, we're expecting transaction volumes to pick up as bigger players return to the market with newly raised capital and the concept of picking up bargains drains away. The consistently strong performance of HMOs isn't going unnoticed, and there continues to be large-scale institutional interest in the sector, which we think will come to fruition at some point. But finally, in summary, it feels like the sector has more of a spotlight than ever before. It feels as though there's enormous weight of money wanting to get in, but there are fewer opportunities available than there should be. And where stock is available, it isn't getting to new capital as sales methods aren't really allowing for it. And the capital that is in play, deal volumes are lower than they should be or could be for matters relating to heightened levels of due diligence and hampered by a complete misalignment of expert opinion informing buyers and sellers in respect of fire safety. Looking ahead, beyond the end of tomorrow, we've then got to absorb the abolition of MDR, which was, unlike rent reform, washed up in the finance bill last week and confirmed despite some last-minute pressure to remove PBSA. How this plays out in the coming days and weeks, we don't quite know. I'm coming to the end, and apologies if it all seemed a little bit negative. I think it's more frustration than anything else because the conviction from investors towards student housing has never been stronger. We've never been having or taking summary inquiries. We should be sat here talking about why we're seeing record transaction volumes, not trying to explain why we're seeing lower investment activity in a sector with so much investor appetite. But I hope I've put a positive spin on that. What I was trying to do is sort of explain why there's so much clamour for student accommodation, yet over the last 12, 18 months, we've seen this, relatively big drop off in transaction volumes. When I shared this with my wife last night, she said I was being overly negative, but I really hope that I didn't come across because I was really just trying to be honest in what we're seeing day to day in our work at the moment. I'll hand back to Rich. Thank you very much.
Perfect, thanks. And I think it is obviously really interesting to get under the hood in terms of why some of these deals are taking longer. So now I think it's good to have that honest view for sure. Just before we kind of go into the polls and the Q&As, obviously, again, we'll send out a recording of this. So we can always look back at it later. But for anyone that does want kind of regular updates on the market, do feel free to reach out or scan the QR codes to get access to our newsletter and other material. Again, we'll send a recording of this so you can always look back a little bit later. What I'll do at this stage, I'll just stop sharing my screen, and Calum, I'll hand it back to you and we'll go through the results of the poll quickly. And then after that, we'll probably spend 10 minutes doing Q&As, just conscious of time, given we're kind of 10 to 2 already. So Calum, I'll hand back to you and we'll just have a quick look at the results from the poll before we do the Q&As.
Great, thanks, Rich. So just jumping straight into the first question here. So how have your expectations changed for the 24-25 PBSA rental growth over the last 3 months? Mixed bag here. More of you kind of sitting on the fence at around 50%. Onto the HMO side of things. So what are your current expectations for rental growth in that sector? Again, a little bit more positive. So sort of between that 3 to 5% growth mark is where a lot of people are expecting. not many people expecting sort of a reduction there, which is good to see. And lastly, how has your overall view towards the student accommodation market shifted over the last 3 months? So again, a pretty mixed bag here. So just under half of you saying that's kind of unchanged, but also a third of you are quite pessimistic. So yeah. So I guess at this stage now, it's probably worth just jumping straight into the Q&A. So we'll try and get through as many of these as we can, but obviously for the ones that have come in live, we can try and reach out afterwards to answer those questions. So jumping straight in to the first question, with Indian and Nigerian students showing a preference for value accommodation and a possible decline in Chinese students, do you see any other demographic that fills the gap in demand for premium PBSA? Rich, I'll probably hand that straight back to you.
Yeah, sure. So yeah, I think it's a fair point, and certainly when we've looked at that budget profile of an Indian student in particular, it is obviously a lot lower than those from China. I think the other thing that's worth noting there, though, is there's going to be a distribution in those budgets. So yes, whilst the average may be lower, if the absolute numbers are very large, then you only need a small percentage that have good budgets to then feel part of that gap. Obviously, there is a number of students from other countries outside of China that, again, typically have higher budgets. So Saudi Arabia springs to mind and others. But they're really small, less than 2% of full-time students, according to latest data. So yeah, I think definitely there is a big reliance on that Chinese market to fill the high-end accommodation. Again, you will get a proportion of the UK market that does pay up, essentially. But yeah, it'll be tough. If we saw a significant reduction in demand from China, some assets and locations will probably struggle to fill that gap, to be honest. So it would be a challenge.
Yeah, for sure. So on to the next question. What is driving the reduction in Chinese students in the UK? So whether that be the Chinese economy, political rhetoric, cheaper alternatives, or reopening of other international student markets post-COVID. So Rich, I don't know if you want to start, or Sam.
Yeah, I don't mind starting and maybe pass it over to Sam. I think certainly, not to steal Sam's thunder, because I know he'll have a view on this as well, but post-COVID, there obviously was a lot of pent-up demand. So whilst we have seen some markets become harder year on year, that's predominantly because last year was so bullish. Again, going back to the example of Glasgow, we saw that particularly. Again, there were issues in Glasgow last year around fake bookings and so on, which again makes it a little bit harder to kind of draw any really firm conclusions. But yeah, I think opening up of borders and as well post-COVID means there are greater number of choices for those from China. Sam, I don't know if you have anything to add, given your exposure on that.
Yeah, I echo what you say, really. Certainly post-COVID as well, Chinese students were required to actually be overseas to have that international qualification recognised. So there were certain things that influenced perhaps last academic year being exceptional. And it may be 2024 is more of a normal year. And I believe the next few months will give us a clearer indication of that, because that is when we would expect to see a growing number of interest and inquiries and bookings from Chinese students. I mean, just some other factors, the pound has strengthened. So, the cost of studying overseas is now more expensive for Chinese students. And some other extra factors, the UK as a study destination still has a positive sentiment on Chinese social media, but educational agents are starting to talk about other destinations that are perhaps cheaper to study in, but where the English is the taught language. So, I mean, just to summarize, I think the next few months are going to be really key for us to draw some stronger conclusions on how different will it be to last year, sorry.
Yep, great. And to kind of switch themes slightly, more on the investor side of things. So are you seeing negative press around student visas and university finances begin to weigh in the mind of investors? So have you seen a drop off in interest, essentially? And I don't know if you've got any thoughts on this one.
I haven't seen this infiltrate. I haven't seen it filter through. I've not had any conversations, not to my experience yet, with investors who seem overly concerned. I think obviously the visa issue seems to be addressed or being addressed. I think the negative press around universities, demand has always been driven by the strength of universities anyway from investors. You hear the term Russell Group, Redbrook a lot. Really, just well-established universities have always been the focus of investor appetite. So I haven't seen this really come through and start to impact the market sentiment towards student housing. No, is the answer.
Yeah, I guess just to add on the visa point, I mean, we looked at the latest data recently, and you need to really wait till Q3 to get the kind of latest information, given that's when most of the visas are kind of issued. But certainly last year we did start to see a drop off in those issued to Indian students and those from Nigeria. So that has started to come off. Chinese numbers are still up. So we'll have to give it a bit more time to see how those visas play out this year. But I think the important thing to note, and there was a lot of press, again, over the last kind of 3 to 6 months about huge drop-offs in international students. The reality is, if most of that's focused around India, I would argue that's not the primary market for most PBSA. Again, it would depend on the asset and location, operator, and so on. But for the most part, I'd expect that impact to be comparatively small than if we saw any drop off in demand from China. So again, I think actually mostly it's from a visa standpoint fairly positive. Again, with the caveat, it will depend on the individual institution and operator if they're heavily exposed to Nigerian students, for example.
Yeah, I think that's right. I think, there are certain instances where if you're looking to invest a particular asset in a particular city and you do see that there's a high dependency on such, then clearly that might change investor sentiment towards a particular opportunity. But I think in the wider, I'll stay with my answer, which is no, this hasn't sort of started to impact yet.
Great, thanks. Probably got time for one or two more, so rattle through these quickly. So another one for you, Ant. There is still some uncertainty around pricing, but what do you think is happening to yields across the sector?
Put you on the spot.
Nice quick one to answer.
Can I sit on the fence? I mean, it's such a mature market now, student, and there are multiple types of assets, and scale plays a role, and micro location and macro location, so many factors. But if I'm coming off the fence, I would say that there has been a bit of a yield shift. I think that's kind of I think we all can appreciate why that has to be the case. But what I would say is I don't think it's been significant, and I don't think it's been as significant as what many were expecting it to be. And I think that's starting to come to fruition now. I think more investors are getting comfortable with the idea that they might push forward sales that they've been holding back, as I referred to in my presentation, because I think they're seeing that with the little bits of information that we're sort of seeing now that there probably hasn't been much change. So I can't go into so much detail because London's its own thing, and then you've got regional centres and all sorts. But it differs between different locations and different asset types. But yeah, there's been a small shift. Yeah, but I don't think that will take long to correct itself. We'll be back where we were before long, and then possibly better than.
Great, thanks. Probably just time for another quick one for Sam, and then we'll try and wrap up. So it'd be good to hear the main factors of digital campaigns that matter to wider stakeholders to help support campaign optimization.
Yeah, I mean, we can look at this through the lens of the mini program being perhaps more of the endpoint. So these digital campaigns are trying to send Chinese tenants to these mini programs to then make an inquiry or booking. I'm not sure if I'm answering the question as direct as I could, but the messaging is super important for the Chinese market, particularly Chinese students that aren't already in the UK. They may not be able to understand the difference between an agent and an operator. They may not understand what direct bookings and come to us to book direct really means. So the messaging is super clear. It needs to be super clear. I'm really just trying to track where those activities are coming from. What is generating the most outcomes in regards to the digital campaigns is really important. So that's really the only answer I can give. It's just we're looking at how can we optimize the number of inquiries that are coming through, which typically is the ROI driver that we're dealing with.
Great, thanks, Sam. And that takes us to 2 o'clock, just over. So I think we've dealt with most of the questions submitted. So for any outstanding ones, we'll try and get in contact and answer these. So that just leaves me to say another big thank you to Sam and Rich, and for all of your comments, and thank you for joining the call. So we hope to see you all again soon, and enjoy the rest of your afternoons.
Thank you very much.
Guys. Thanks very much.
Take care.
Bye-bye.